What if I told you that some of the wealthiest people in the world pay a lower effective tax rate than you do? Not by cheating, but by borrowing money against assets they never sell. This isn't a conspiracy theory. It's a documented strategy, and understanding it will completely change how you think about debt. Most people treat all debt the same way. Credit card, car loan, mortgage, it's all bad. Get rid of it as fast as possible. And for high-interest consumer debt, that instinct is mostly right. But that framing causes people to miss something important. Not all debt is the same, and the wealthy have known this for a long time. Here's the core idea. When you sell an asset, say shares of stock that have gone up in value, you owe capital gains tax on the profit. In many jurisdictions, that's between 15 and 20%, sometimes more. But if you never sell, you never trigger that tax event. So what do you do when you need cash? You borrow against the asset instead. This is sometimes called the buy, borrow, die strategy, and it's been discussed in academic and tax policy literature for years. The mechanics are straightforward. You accumulate appreciating assets, stocks, real estate, a business. The asset grows in value. You take out a loan using that asset as collateral. You live on the loan proceeds, which are not taxable income. You pay the loan interest, which is often very low when secured by high-quality assets. And eventually, when you die, your heirs receive the assets at a stepped-up cost basis under current U.S. tax law, meaning the embedded capital gains can disappear entirely. ProPublica reported in their analysis of IRS data that some of America's wealthiest individuals paid effective federal income tax rates in the low single digits relative to the growth in their net worth, precisely because that wealth was never realized as taxable income. Now here's where I have to be completely honest with you about what this means for regular people, because most of what you'll see online about this strategy skips the part where it can go badly wrong. Borrowing against assets only works if the asset holds its value. If you take a margin loan against your stock portfolio and the market drops 30%, which it has done multiple times historically, your broker can issue a margin call. That means you're forced to sell at the worst possible time, locking in losses and potentially owing taxes anyway. The 2008 financial crisis saw exactly this happen to investors who were leveraged at the wrong moment. The wealthy can absorb that volatility. They have diversified assets, long-time horizons, and advisors who manage the risk actively. A regular person with a $200,000 portfolio and a margin loan does not have the same cushion. So what can you actually take from this? Two things. First, if you own a home, a mortgage is already a version of this logic. You're using leverage on an appreciating asset while maintaining liquidity. The math on paying down a low fixed-rate mortgage aggressively versus investing the difference in a diversified index fund has historically favored investing, according to Vanguard's research on opportunity cost and asset allocation. Second, the deeper lesson isn't about debt at all. It's about accumulating assets that appreciate and being tax-aware about when and how you access them. A tax-advantaged account like a Roth IRA lets your investments grow and be withdrawn tax-free. That's a version of the same principle. Grow first, minimize the tax drag on exit. The one concrete step you can take this week is to look at any debt you currently carry and ask one question. Is this debt attached to an asset that's likely to grow in value, or is it attached to something that depreciates? That single distinction separates wealth-building debt from wealth-destroying debt. Everything else follows from there.